Live from New York City this morning. Good morning, good morning. Let's get you to the weekend. Your equity market on the S&P 500 just about positive. Back in a bull market. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York, coming up, the S&P 500 back in a bull market, GM delivering another win for Tesla, and Trump charged over secret documents. We begin with the big issue. The bull market is back, fueled by a tanker full of pessimism. The S&P 500 rallying more than 20% from an October low. And the bulls think there's more to come. Deutsche Bank's Binky Charter looking for 4,500, suggesting that while the move up in positioning this year looks done, if earnings remain robust, so will buybacks, and equities should continue to grind higher. As not even 3 of the biggest bank failures in this country's history have been enough to hold us back, big tech has been picking up the slack, and big tech just keeps getting bigger. The 5 biggest companies in the S&P 500 now accounting for a near record 24% of the benchmark. Bank of America's Savita Subramanian pointing out that Apple alone is now bigger than the Russell 2000. Elsewhere, the bears are still clinging to positions they've held all year. Morgan Stanley's Mike Wilson insisting the boom-bust period that began in 2020 is currently in the bust part of the earnings cycle. JP Morgan's Marko Kolanovic saying the consensus view that the worst of pressures is behind us will likely be proven wrong, as the impact of monetary tightening worked historically with a lag and certain growth supports are waning. To discuss the closeout of the week, to start this programme, I'm pleased to say that joining us now is a good friend of ours, Mohammed Al-Erin of Queen's College, Cambridge. Mohammed, let's start there. Just how long and variable are these long and variable lags?
Well, let's start with a good week. It's been a calm week because next week will not be calm. Look, no one knows, John. Absolutely no one knows. There's a whole set of theories out there, some suggesting that the lags are quite short now because the market does all the heavy lifting for the Fed. The others that suggest that the lags are long, maybe 12 to 18 months. So we simply don't know. And I'm going to keep on repeating that there's lots of things we don't know and that we're only going to discover over the next 6 to 12 months.
One thing we do know over the last 48 hours, Mohammed, is that we've been whipsawed by 2 things. Surprise rate hikes this week, the RBA down under in Australia, our northern neighbours up in Canada, and then on the other side, whipsawed by soft economic data, jobless claims yesterday, showing some signs of breaking out. From your perspective, what are you putting more weight on right now? The surprise central bank decisions from elsewhere or the disappointing data we saw yesterday morning?
So I tend to put more focus on the former, on the surprise move by the central banks in Australia and Canada. Those are 2 central banks that had paused and now are back hiking because the data, not only the underlying data that suggests that inflation is sticky, but what they see ahead suggests that the inflation is going to continue to be an issue. So I put more emphasis on that. Having said that, I don't dismiss the jobless claims, but you know that jobless claims, this weekly series, is inherently noisy. So one would need to see the next 4 to 6 weeks to get a better feel.
I was looking at some labour market expectations and forecasts from Ellen Zettner of Morgan Stanley. Mohammed, her and the team are looking for 4% unemployment 4Q23. They're looking for 4.4 in 4Q24. Their expectation for unemployment is 12 months further out than where the Federal Reserve is at year-end. Year-end, the Federal Reserve's at 4.5. Morgan Stanley and Ellen Zettner get close to 4.5 12 months later. Mohammed, it's not just the decision that we're teeing up for next week, it's the projections as well. What do you think those projections are going to look like over at the Fed?
So I think they're going to correct yet again. You know, they've been too pessimistic on the unemployment rate. And I think that they're going to correct that because I don't see us getting to where they think we're going to get by the end of the year. I think the unemployment rate will be lower. I think they're going to correct the inflation forecasts and they're going to take them up yet again. John, if you talk about the labor market, keep an eye out for wages. Wage growth, depending on what you look at, is steady at around 5%. And that is too high for a 2% inflation target.
Would you expect that median dot then to come up in the dot plot on Wednesday?
Yeah, I do. I think they'll go there. but it's going to be, the press conference is going to be absolutely the most interesting element of next Wednesday.
What is it about the presser that you think is interesting?
So first, let's see where we start from. They have guided the market. As you know, a top Fed official guided us to expect a skip. And that will make sense if Tuesday's inflation data comes in well below forecasts. Why? Because this is a highly data-dependent Fed. Having said that, they haven't dealt with the larger framing issue. And you're not going to get me to front-run my FT article again. I'm going to have to wait till Monday. But there's the larger framing issue that is not being looked at. So how they describe that the skip, which the market expects, is going to be critical. Now, if they don't get favorable inflation numbers, they're in a really hard situation because they will have to surprise the market. So it's going to be next week is going to be absolutely fascinating. Tuesday, Wednesday is going to be probably the most interesting 24 hours, a little bit more, 36 hours that we've seen for a long time.
Well, you've got to give us a sneak peek now, Mohammed, because once you've publicised a different publication, the fair trade is to just give me a sneak peek of what's in that piece that comes out next week.
I think we've lost audio, John. I'm just kidding. No, I'm going to talk a little bit about how none of the three options being discussed, pause, hike, or skip, is an optimal one. Of the three, skip is probably the least optimal one. And the problem is that there are two much bigger issues. One, as you know, you and I have talked about this, what is the right inflation target for this economy, given what we're seeing on the supply side? That's an issue that has to be discussed in a very comprehensive manner. It's critical because if you've got the wrong inflation target, you will cause unnecessary pain to this economy. And then the other issue is how you make policy.
Well, let's build on that a little bit more, because, Mohammed, you've said repeatedly that they might have to tolerate a higher inflation rate going forward from here. You've also mentioned several times that ultimately, if you design that inflation target today, it wouldn't be 2, might be closer to 3. I caught up with some former colleagues of yours, some friends as well, over at PIMCO earlier this week. They put out their secular outlook, Mohammed, and they mentioned tolerating 2-point-something inflation. That's only part of the story. The other part of it is the appropriate time horizon looking out to just keep forecasting 2. Forecast 2 and accept something higher than that. Mohammed, how do you think about that dynamic now?
So the most likely path is that the Fed will keep on pushing back the 2%, still promising us 2%. We will get to a 2% target and tolerate something higher on that journey. That's the right approach to the journey, because if it tries to get us to 2% quickly, we will have an unnecessary recession and we will have unnecessary financial instability. So it is the correct thing to target higher than 2% for the journey. The big question is the destination. Is 2% the right destination? And the way we're going to get out of that is during the journey, we're going to find out that 3% inflation is stable. And if 3% inflation is stable, then the transition to a 3% target becomes much easier.
So how much damage do we need to do to the economy if 2% is still the goal and they remain committed to that? That's something we've discussed for the last 12 months. Chairman Powell, at the end of last August, talked about the pain that we'd need to see over in Jackson Hole in the economy and the labour market to get inflation back to target. Mohammed, I just wonder how decent a case study of Europe is right now for our current situation here in the United States. Europe had no growth in Q4. It had no growth in Q1. And inflation is still a problem. Guy Johnson and myself were talking about this time yesterday. Mohammed, what can be learned from Europe's experience with inflation and negative economic growth over the last 9 months?
Not very much for the US, because the US has two huge advantages relative to Europe. They are less prone to an energy crisis, and they don't have the massive food price issue that Europe has. So I don't think you can extrapolate. You know, John, you've heard me say over and over again, and there's no need for the U.S. economy to go into recession. You've heard me question all these recession calls that keep on being pushed further and further back as growth proves robust. There's no need to go into recession. The only reason we'd go into recession is if we get another Fed policy mistake. The U.S. economy is vibrant. The labor market is doing very well, and there's exciting productivity enhancing technology being put to work as we speak. So the only reason you push us into recession is because you're pursuing the wrong target without being brave enough and open-minded enough to ask yourself, if I started today, what would be the right inflation target?
There's a big treasury market question in that as well, Mohammed. So let's finish there. Do you think yields should be higher on the prospect of inflation being sticky and tolerating more of it? Or should bond yields be lower at the lower end because of the growth risks associated with trying to achieve 2% inflation?
Yeah, so that all depends on what the Fed does. If the Fed tolerates 2 and something, as you put it, as my PIMCO friends and colleagues put it, there's no need to have a recession. There's no need to have bond yields collapse, right? And I could see bond yields staying here going higher because we also have a supply issue, as you know, from the fiscal side.
Mohammed, final question. We've talked about this over the last couple of weeks together. The Federal Reserve, you said 25, they're going to hike. They're going to hike. I've played fair. I've said, you know, based on the information we have so far, we've still got CPI still to come. Where are you now?
So I thought your final question would be Manchester City versus Inter Milan.
I was going to get to that, but let's finish here.
So your final will be that?
That'll be my final once we've dealt with the market and the bond market stuff.
Look, it's very hard to project something different from what they've guided to. If they end up doing something different, John, their credibility will be hit. So the market, you saw the market is probability of a hike next Wednesday is down around 20%. It used to be 70% before they guided us to the skip. So, you know, the Fed now has got to deliver that. And its big hope, everybody's hope, is that the inflation the inflation data comes in well below the consensus forecast.
Was that yes to a hike?
No, they're going to skip now and hike after that.
OK, so July for a hike.
Yes.
OK, so the final, City or Inter?
No hesitation, City.
OK, there we go. That was easy. That's why you wanted an easy one at the end. Mohammed, it's good to see you. Good friend of this programme, good friend of ours. Mohammed Al-Erin there on the latest. Your equity market a bit softer through most of this morning to basically unchanged, now turning positive as we get closer to the opening bell. Let's get you some movers. Here's Abby.
John, let's take a look at a couple of the stocks that are helping the markets go closer to even, maybe even a little bit higher in the S&P 500. Higher on the week coming into today. Tesla is having its best day since the end of March, up 6.2% on the news that GM will start using Tesla's extensive charging network beginning in early 2024. Plus, GM will adopt Tesla's connector. This is Tesla's highest level since early October of last year. GM also higher, up 4%. And then take a look at DocuSign, up nearly 7%, jumping on a 32% adjusted earnings beat. Sales were better by 3%. The revenue forecast was better, but many analysts see it as conservative. Net, we've got some big winners here, so let's see whether or not it can pull the indexes around, John.
Abby, thank you. Coming up on this programme, investors looking ahead to the Fed as markets enter new territory.
I think that it gets pretty choppy from here, but the demand-supply balance still looks, constructive. So I would say a grind higher, 4,500 by year-end. Soft landing will easily give you 5,000.
If we get a soft landing, Binky Chowdhury there of Deutsche Bank. That conversation coming up next.
They haven't dealt with the larger framing issue. And you're not going to get me to front run my FT article again. You'll have to wait till Monday. But there's a larger framing issue that is not being looked at. So how they describe that the skip, which the market expects, is going to be critical. Now, if they don't get favorable inflation numbers, they're in a really hard situation because they will have to surprise the market. So it's going to be next week is going to be absolutely fascinating.
Next week is going to be absolutely fascinating. Mohammed Al-Erin of the Federal Reserve looking ahead to next week. CPI on Tuesday, Federal Reserve after that. If they skip, will they go 25 in July? Lots to talk about. Kit Jukes of SocGen saying this morning. Have we become ostriches with a short-term memory of 10 seconds and a tendency to head off in one direction or another at full speed for reasons we can't remember? Daryl Crocker, Wells Fargo. Morgan Stanley's Michael Kushner. Join us now for more. Michael, have we got our head in the sand?
We seem to be bouncing around from one extreme to the other. We're optimistic, we're pessimistic, optimistic, pessimistic. I think that relates to the fuzziness of what's going on in the world. We're in this transition. Manufacturing is weakening, service sectors are strengthening, labor markets are changing around. We've got strength in some sectors, weakness in other sectors. It's very obscure in terms of what the actual fundamental underlying trends are. So I think we do have a tendency to bounce around in terms of what we think is going on.
Got a lot of history to look at. Darryl Cronk, you wrote this. History shows the S&P 500 doesn't bottom until, on average, 6 months after the first Fed rate cut. That rate cut's not coming anytime soon. At the same time, Bank of America published, Darryl, just moments ago. Let me share this one with you. The bear market is over. 90% plus at a time. The S&P 500 rises over the next 12 months after recovering from a bear. So history cuts both ways here, Darryl. Which one's which?
Yeah, it does. I think the conditions, though, are vastly different this time. And to your earlier question, I think the market's having a little bit of a summer fling that ultimately ends in heartbreak in the fall as those conditions just keep tightening. The leadership, as you know, is too narrow. I mean, now at the end of May, if you took out the 8 stocks, the index was negative. Now you have to take out the 20 top stocks in the index to get negative. So the breadth is widening. That's positive, right? But you still have 6 of the 11 GIC sectors in the S&P that are negative year to date. Large has outperformed small by 500 basis points, so you're not getting any leadership out of small cap at this point. You should be if this is a durable rally in the next bull market. So the signs are just not there. And frankly, the VIX at 13 and change, implied volatility is just way too low heading into whether it's next week or the summer months. Quite frankly, we think investors should be using that low volatility right now to hedge for that potential heartbreak that may come later this fall.
Well, Darryl, the point that you're making is it's time to get defensive in stocks. Does that translate as a wholesale cutting back of your equity allocation or just getting more defensive sector-wise?
I think it's a little bit of both. We've been underweight equities in portfolios basically since last year, which served us well in 22, hasn't served us well so far in early 23. But I think you want to look where you can find value. So I think, energy down 7%, most energy stocks trading at 9 times multiples with a 3% dividend yield, to me looks more attractive than other cyclical areas, places, where you have the best to worst, technology best, energy worst, dispersion of 41% year to date on sector over sector performance. So we think energy is okay. We think healthcare is good. We would fade probably some of the tech, discretionary and communication services. They're all up 30% plus year to date.
Massive moves year to date on that front. There's an old cliche that capital goes to where it's treated best. And Michael, I'd be asking you this morning, does it get treated best in equities or in bonds at the moment?
It's a good question. I think bonds are very competitive with other asset classes, equities or others. The high yield market, people go, well, if a recession is coming, why is high yield so reasonably well behaved? And the reason is you get 8 to 9% yields in high yield in an economy which is doing okay. And an 8 to 9% yield, if there's not going to be a meaningfully large recession, how are you really going to beat that in equities or other components of fixed income? So I think that the high yield market is being held up quite strongly by the fact that people like yield, and yield is high now, even if spreads are not so high.
Michael, you've got all these opportunities in fixed income that you've just suggested. You've seen what's been ripping in the equity market. I'd be asking 5 trillion questions. Why have we got $5 trillion sitting in money market funds if opportunities elsewhere are that good?
Well, I think this is the reason to be optimistic that even if we have a bit of turmoil in the economy, as long as it doesn't get too weak, the supply-demand imbalance about these financial assets that are sitting on the sidelines, which could be deployed in financial assets, whether it's bonds, mortgages, high yield credit, or in general, or equities, is out there. So I think the longer we go without a recession, and now we're 15 months or so from the tightening, the S&P has come almost unchanged over 15 months. The 10-year Treasury is unchanged basically over the last 15 months since June of 12 months since last year, that people get sucked into the market. And I think as opposed to potentially having a lot of volatility over the summer, we could have a surprising melt up, in asset prices this summer.
Oh, some opposing views there. So let's build on that a little bit more. Darryl Cronk, if people are going to sit in cash, and many people have done, they're trapped there, being rewarded to be trapped, you get 5%, I know that, but elsewhere things are ripping. Just how sticky is that money? And what's the catalyst, Darryl, for that money to start being deployed elsewhere?
Yeah, it's a good question, John, and one we spend a lot of time in strategy committee looking at. I would say, what I think could surprise to the upside, to that point, is even next week. So you're going to have the headline CPI drop a full point from 5% to basically 4% if we hit consensus. And the 3-month average on inflation is 2.2% at the headline. The problem is the core is still running at 5.3 and the 3-month average at 4.8 and still rising, way too high for the Fed. Right? So I do think the Fed has to do more work later this year. The reality is the economy is at basically stall speed. We're at 1.5% GDP growth. That is not enough cushion when you've got the fastest tightening cycle since '81, and 7 of the last 9 Fed tightening cycles have ended in recession. So we still think later this year the true data and dynamics play out and the economy does drop into recession. We're already there on earnings. We've had 2 quarters in a row of negative growth. Leading economic indicators are in recessionary territory. The data just doesn't suggest otherwise at this point.
How would you suggest the winners of the moment would perform in the downturn that you're anticipating? What would happen to Nvidia? What would happen to Meta?
I think they have to come down here. I mean, look, they're up, 70+%. I mean, it wasn't that long ago, John, we were writing about a crypto bubble and a cannabis bubble, right? You could argue that there's some AI bubble-ish tendencies here of what's playing out right now in the latest move. Technology has done well, but as I said before, if you get below the surface and I take out those top tech names, the vast majority of even the S&P 500 technology sector is still off 20% from its previous 52-week highs. So even the tech sector broadly below those names is not participating as widely as it should, again, if this is a durable, sustainable, broad-based rally.
Darryl Cronk, Michael Kushner, to the two of you, thank you. Going into the weekend. Enjoy the weekend, gents, and let's hope today is a quiet session going into a busy week next week. Coming up, the morning calls, and later we'll catch up with Alpine Saxon Woods' Sarah Hunt, joining us around the opening bout and taking a look at Tesla too. That stock doing better than good this year and doing okay this morning too. Month to date so far, big outperformance in the Russell. So far in the session, bit of underperformance. We're negative there and slightly positive on the S&P 500. That's the price action. Let's get you some morning calls. First up, Piper Sandler raising its price target for Oracle to 130. The analyst citing favourable AI and cloud tailwinds. Next up, Guggenheim cutting its price target for Nike to 135, expecting slower than expected China recovery to weigh on earnings. And finally, Citi, more than doubling its price target for Carvana to 25, playing catch-up, highlighting the company's improved outlook amid a stabilising auto market. That stock at 25.47 and positive 5%. Coming up next, another win for Tesla's Elon Musk. Heading towards a 4th week of gains on the S&P 500, potentially the longest weekly winning streak of the year so far. On the Nasdaq, slightly negative on the week, and on the month, only up by a little more than 1%. So as we assess the bull market from the lows of October and talk about this narrow leadership, keep an eye on where the recent outperformance has been in a Russell. The Russell up on the month by a little more than 7%. There's your opening bout. Switch on the board and get to the bond market. A bond market that's been squeezed, whipsawed by developments over the last couple of days. The Central Bank of Australia, then Canada, surprising with rate hikes, sending yields higher. Then we had a little bit of soft data in America. Jobless claims disappointing, flying higher. The wrong kind of upside surprise on claims, driving yields lower. This morning, yields up again by 3 or 4 basis points, going into a busy week next week. 375.68 on a 10-year, on a 2-year this morning. We look at a little something like this, up 5 basis points to just north of 456. That means the dollar showing a touch of strength, the euro some weakness, 107.69. And look out below on crude, just about holding on to 71 here. We're down by 0.2%. For the broader equity market, about 40 seconds into the session, we drift higher on the S&P by 0.3%, on the Nasdaq up by 0.5. The one sector to watch at the open, EVs. Tesla shares climbing for an 11th consecutive day thanks to GM's agreement to join the company's charging network. The GM CEO, Mary Barra, writing in a statement that the partnership could, quote, help move the industry towards a single North American charging standard. Ed Ludlow has more. Morning, Ed.
Yeah, currently headed for 11th straight day of gains, as you point out, John, matching the streak that Tesla hit in January of 2021. I don't often do this, John, but I'm going to get technical because I look at this stock. RSI has just hit 86. We're trading above 200, 150-day moving averages. Just the momentum's there, but how long does this last is the question. In terms of the details, from 2024, General Motors EV owners will have access to the Tesla supercharger network, around 12,000 additional chargers, but they will have to use an adapter. Starting in 2025, GM will modify production so that the EVs they're building have a North American Charging Standard, or NACS, port, making it easier. Of course, this is a move that Ford has already announced, and reading the sell-side reaction, industry participants and sources that I know, this is now relatively definitive, right? You have the three biggest US-based makers of electric vehicles adopting this standard. The assumption now is that the rest will follow, and that those operating charging networks with CCS standard, you look at names like Electrify America, EVgo, and ChargePoint as examples, they now have to think about what they're going to do in order to remain competitive. But Tesla, wow. Tesla now changing how we think about it in some ways, but the stock up 6%, 11th straight day of gains, and trading at its highest level since the first week of October.
And not just Tesla, Ed, but GM, General Motors as well. Ed, can we just sort of sit on this for a moment longer?
Please.
What a win this is for Elon Musk and Tesla. Frozen out of talks at the White House when others were going around cozying up, talking about GM, Ford, Mary Barra, very close seemingly with the President of the United States. And then this is the industry, this is the individual setting the industry standard for everybody else. And how much of a win is this for Elon Musk?
Yeah, look, I started reporting on Tesla in 2018, and it's completely fair to say that since that point, everyone, whether you are a competitor, a Tesla employee, an investor, or an analyst in this field, they accept the technological leadership that Tesla has, both on the sort of product vehicle side, but also the charging infrastructure. Tesla moved quickly and invested heavily in charging. Now that is starting to pay dividends. I also would point out, John, how this came about. Mary Barra broke a 7-month silence on Twitter, tweeted it, and then did a Spaces with Elon Musk. And it makes you think about, the kind of position that Elon Musk and Tesla are in how they're engaging with their industry peers.
Just a big win in a big way, and doing it on his platform, as you suggested. Ed, thank you. Ed Ludler there on the latest. Dan Ives of Wedbush adding Tesla to the best ideas list as if it wasn't there already for him, raising its price target to 300. Ives saying this, quote, "We believe this is a large monetization opportunity. In a nutshell, Musk and Tesla are playing chess, while other automakers are playing checkers in this broader EV green tidal wave." That stock is up by almost 6% and higher by close to 100% year to date. Just a phenomenal run in 2023. Want to stick with the autos. Carvana extended gains following a record one-day advance. Bloomberg's Abigail Doolittle has more. Hey, Abby.
Hey, John. Well, it is really pretty amazing because this stock is up 12% after that 56% record climb yesterday. Over the last several weeks, 9 days are comprised of days that are up more than 10%. So huge gains. But what's so interesting, on the week, the stock up 70%. It's only the best week since early February. That speaks to the volatility, and a lot of the volatility has to do with the shorts. There is a 51% bearish short interest on this stock. And if you take a look at the shares from the peak, they're down about 90%. But from last year's low, they're up 600%. Again, speaking to the volatility yesterday and recently, the shorts really getting killed in this. And of course, has to do with the fact that EBITDA outlook for the current quarter of about 50 million, much better than the projected loss, helping folks, investors, become a little bit more comfortable with the idea that this company, this online car company, is cutting costs and maybe turning a corner.
The surprise being they might actually make some money, some EBITDA, some profit. Abby, thank you. We're up by 11% in early trading there, adding some more weight to the recent rally for Carvana. Turning to retail, what a struggle it's been for Target. Under pressure as Citi cuts the stock to neutral. The analyst saying slowing sales and traffic piling up. Target's high exposure to discretionary sales will not serve them well in the current macro backdrop. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, slowing foot traffic, tough competition. It's a toxic combination for Target, at least if you ask Citigroup. The bank's traffic tracker data showed that foot traffic slowed in the last week of May, and then it slowed even further in the first week of June. That led them to this downgrading Target to neutral from a buy. And making matters worse, of course, Citi here sees Walmart gaining market share. Like you mentioned, Target does have that high discretionary exposure that's not great in this environment that we're living in of slowing growth and still high inflation. Now, of course, this downgrade follows a pretty brutal stretch for Target stock. If you look year to date, it's down about 12%, down 16% just in the past month or so. But Citi says the risk here is for further downside, and you're definitely seeing that this morning. Shares off about 1.8% at the moment.
Katie, have you noticed that the South Side are very willing to talk about the product mix at Target not being favourable to the stock, but less willing to talk about the elephant in the room, which is the tension between them and the LGBTQ community?
You have seen that a little bit. It kind of makes sense here that they're sticking just to the product mix, but those social issues, very, very much, if you look on social media, it's a different story.
Dominant at the moment. That's the dominant part of the conversation. Katie, thank you. That stock is down by about 1.7%. Really weak run over the last few weeks, that's for sure. Also looking at DocuSign, shares jumping after the company beats Q1 earnings. The CEO writing in a statement, quote, "As we continue to execute on our strategy and leverage our competitive advantages, notably in, guess what, AI, DocuSign is well positioned for the future." Isabel Lee has more. Hey, Isabel.
Hey, John, it looks to be a great day or a great start for DocuSign. Shares rose around 10% when the market opened and now has since paired gains to around 4%. Year to date, it's up 10%. So it's a beat across the board. Revenue jumped 12% year over year and it increased by the same percentage in the subscription side. Adjusted EPS rose to 72 cents. That's compared to the 38 cents year over year and the 55-cent estimate. The company announced a slew of new products and services, and many analysts were bullish. They said that they were impressed, and Wedbush, again, also increasing its price target for the company. Some, however, didn't think that it was that impressive when it comes to their outlook. They thought that it was a bit conservative.
Stock up 2.8%. Isabel, thank you. I think Lisa called that a pandemic darling a little bit earlier on this morning. A few of them doing well. Thinking of Carvana the last couple of days too. Your broader equity market positive by 0.2% this morning. We've heard a lot from the bulls.
I think that it gets pretty choppy from here, but the demand-supply balance still looks, constructive. So I would say a grind higher, 4,500 by year end. Soft landing will easily give you 5,000.
We've also heard a lot from the bears. Bank of America's Michael Hartnett writing, quote, "Q1 recession fear replaced by Q2 Goldilocks greed. The S&P 500 breaking out bull market bubbly," though he stresses that if you have a look at how things progressed through May, you take out a magnificent 7, and we're up more than a sober 1% year to date. The Fed ain't done with hikes, so we stick with sell the last rate hike call. That's his call. Stays bearish. Michael Hartnett of Bank of America. With us now for her perspective, Sarah Hunt of Alpine Saxon Woods. Sarah, is this a market you want to chase or one you want to run from?
It's such a difficult question, and I think that this is what everybody is struggling with right now. I think part of the move in the Russell has been a bit of a catch-up, so everyone's buying the laggards because you've seen the S&P move ahead, again, in a very, very narrow way. I think it really is going to depend on how that CPI data comes in next week and what the Fed does. But you're facing a bunch of tailwinds that are coming for companies, which is partially on the earnings front, because if you do get that drop in inflation that people are hoping for, that means the Fed can slow down or even, pivot, which we're not even talking about anymore. It means that you're going to see some degradation of earnings because some of that earnings bullishness has come on the back of inflation and not driving revenues higher. You also have some issues coming in with spending, with student loan resumptions. And I think you're just going to start to see some issues on the consumer side. And I think some of the weekend of that you're already starting to see in things like Dollar General.
So, Sarah, have you got your doubts about the outperformance we've seen so far this month on the Russell? It's pretty big outperformance. The small cap's up by something like 7% plus. The Nasdaq, despite the headlines, which cover what's happened since October, the Nasdaq over the last few weeks hasn't really done it.
Well, I think there's somewhat of a catch up here because the small cap stocks had not had any sort of recovery. So I think to the extent that people are looking at the economy and saying, well, maybe it isn't going to be a terrible recession or a deep recession, or maybe we're just going to get a slowdown, that's positive for the stocks in the Russell 2000 because they're mostly domestic facing and they should see some growth if the economy isn't terrible. I think the bigger question is overall market and some of the multiples that we're moving to, where do those stocks go and what does the Fed do and how long do we stay at higher elevated interest rates, I think that's going to be a big part of the question of how equity markets can perform over the next 12 to 18 months.
Well, let's talk about where the surprises have come from, Sarah. The labour market is so much stronger than we thought it would be at this point of the year, looking back, say, 12 months ago, looking out 12 months. The housing market is so much stronger in the face of 5% Fed funds and 7% mortgage rates, given that still, as far as I'm told by places like Redfin, a third of purchases in this country are being done all cash. Are we finding out, and I asked this question of Mohammed about 40 minutes ago, are these long and variable lags a whole lot longer, or are we just finding out this US economy is a whole lot more resilient?
I think it's a combination of the two. I think it has to be an and. Part of the issue on the housing front is that you don't have a lot of people in existing homes willing to sell those homes because their mortgages are so low. And to the extent that so many people are buying with cash and developers are able to offer some sort of incentives to get people into brand new home sales, I think that's part of what's driving the home market. But that's still bullish for the home sellers, right? So that's a good thing for them. On the labor side, you did see one increase in jobless claims. 1 week is too short a period of time to even try to extrapolate that data. But I do have to think about when I go through places like the new LaGuardia Airport and everything is a kiosk and there are very few people working in some of those retail stores, if that's going to be the new way that companies goose margins, which is making sure that they have the least amount of employees possible. I am a little bit concerned about that going forward, but I think we just have to see how that plays out.
Sarah, given everything we've just said, favourite sectors right now, what are they?
I know this is going to sound like a broken record, but we still like energy. It's had some issues going forward. They're still releasing oil from the SPR. You would think that with oil prices down this low, they wouldn't be doing that. I think that there are some things that are going to reverse that are positive on the supply side, that even if you don't get a major cut from Saudi or the fact that you've got more Russian crude on the market than we thought we would have, you're going to have a reversal of some of the ability of countries to keep pulling oil out of those strategic reserves that they have as well. And I think that you've seen almost a trough in gas prices. I don't want to call that here. It depends a lot on weather. But the U.S. has definitely got a different dynamic going on than Europe does on the energy front. And that's been favorable to consumers so far this year.
Sarah, why do you think it's so out of favor in 2023? This trade did so well the previous 2 years.
I think partially because it did so well the previous 2 years, partially because people are still looking at that ESG component and saying, you know what, hydrocarbons are going to go away. Well, there's going to be a transition, but that transition tail is going to take a lot longer than a lot of people are expecting. So a lot of the companies that people have given up for debt are not really going to die, especially not in the next 5 to 10 years. And I think that that's an important part of the global conversation that we need to be having, because you look at countries like Germany that are stuck with higher energy prices for longer because of choices that they made in the last several years to get rid of some of their conventional energy supply. And you have to think that that conversation has to be more broadly based, and you have to think about all the different pieces of that puzzle.
Sarah, just to finish then, can you describe the type of energy company you want exposure to? Not all companies, as you know better than me, are created equally. Where do you want to be? Where don't you want to be?
Well, I think that right now we see some positive momentum for the service sector. If you really are troughing on the rig count, you've got some U.S. service stocks that can do well. I think that there are places that play into some of these transitions like LNG. I've mentioned Chart Industries before. I still think that that's got some really good possibilities going forward, because you are going to see a larger grouping of LNG companies do better going forward. Some of the majors are more involved in that than others, and some of the majors are looking at alternative fuels more than others. And I think that trying to pick and choose within those is really where you want to be looking in the energy sector right now.
Sarah, does it matter who's in the White House? I asked that question because think about who's in the White House right now and how well energy has played out through his term.
I think it matters in terms of policy directionals and longer term, right? Energy stocks tend to trade in waves, and you try to catch them when they're down and get rid of them when they're up. Well, we're back down to energy being 2% of the S&P right now versus the 6 or so that it was just recently on the run up in energy prices. I think the longer term policy directives matter, and I think whether or not you can get permit reform and some of the other stuff that has been talked about, I think that does matter. But it doesn't matter if you're in the middle of a long cycle one way or the other. It's not as important who's in the White House, but it is part of the longer term consequences.
Sarah Hunt, thank you on the latest. Still likes energy this morning, a little bit softer. Sarah, have a good weekend. It's good to see you. 15 minutes into the session, equities positive by 0.4%. The outperformance again on the NASDAQ. Coming up, the politics. Former President Donald Trump indicted.
It's election interference at the highest level. I'm an innocent man. I'm an innocent person.
That conversation up next.
It's election interference at the highest level. There's never been anything like what's happened. I'm an innocent man, I'm an innocent person, and we will fight this out just like we've been fighting for 7 years. It would be wonderful if we could devote our full time to making America great again, and that's exactly what we did. But now, again, our country is in decline. We're a failing nation, and this is what they do.
According to 3 people familiar with the matter, the former president indicted over his refusal to return classified documents found at his Florida home. A former president has never been charged with committing federal crimes.
Trump's not the only person that's had took records home with him. There's kind of a broader historical question about how these laws were enforced, and you know, President Trump is trying to make a case that both there's different treatment here for him, as well as a situation where these laws were never enforced in the way that the Justice Department is proposing to enforce those laws. You know, those are both questions that the Justice Department is going to have to answer as this case moves forward.
We get lucky this morning in New York. Bloomberg's Anne-Marie. AMH, where are we going with this?
Well, he's been indicted, Jonathan. This is according to the reporting that's out there, including in Bloomberg News. And obviously, everyone's talking about what happens on Tuesday, because then he'll have to show up to court. And this is being handled in Miami. What we do know from this indictment, and we could get the document released as early as today, the former president faces 7 charges. They contain willful retention of national defense information, corruptly concealing documents, conspiring to obstruct justice, and making false statements. Jonathan, some of these allegations could mean the former president could face 10, even 20 years in prison. Now, obviously, he is a former president. No one thinks that he potentially could face this kind of time behind bars. But these are serious, serious issues. His own attorney general, Bill Barr, leading up to this indictment, had said that this is going to be the hardest case for the former president, given there's a lot of legal challenges around him now. And he almost also said it's of his own doing, because he was there, in Bill Barr's words, jerking around the DOJ when all they wanted was these documents back. And the former president, we saw that in the raid in Mar-a-Lago in August, was not giving them back. And there had to be a subpoena, and then they had to go take them.
Could you build on that, the difference between what's happened here in this case and what's happened elsewhere, when we've heard tons of stories of current officials, former officials, who have done something similar, taken documents they shouldn't have gone home with?
That's right. You have the former president's own vice president, Mike Pence, had documents taken home. He called the authorities. They came, took them, and now that case is done now, and that they're moving on from that. The current president as well, Joe Biden, had documents found as well in his home and his office. They called the authorities. Authorities then came and checked all of his properties and took those documents. There's a special counsel right now facing the current president, Joe Biden, that is still pending. The difference is obviously Pence and Biden both called the authorities and wanted nothing to do with these documents, knew that they had to go back to the National Archives. The former president, what many believe he was doing, was hoarding these documents. There was a subpoena to go get them, and he would not give them up.
AMH, on the latest, when we get more facts, we'll bring them to you on Bloomberg TV and radio. Anne-Marie, good to see you here in New York, of course. 22 minutes into the session, call it 23. We're advancing by about 0.5%. The Nasdaq is where the outperformance is this morning. Abby has more. Hey, Abby.
Hey, John. Well, it certainly has to do with those big tech sectors, really to the upside. And on the week, the S&P 500 higher for a 4th week in a row, the longest weekly winning streak in almost a year, well, since August of last year. But take a look at consumer discretionary tech and communication services, all higher to the downside: materials, energy, and utilities. Let's take a look at a theme that is just really the big theme this week, which is, and the month, to your point, is the Russell 2000 really outperforming, up 2.5% to the Nasdaq 100, up 0.7%. This doesn't quite illustrate the degree of the spread there, but nonetheless, we have outperformance for small cap.
Abby, certainly not the story of the year anyway. The story of the week, the story of the month. Abby, thank you for that. Outperformance on the Nasdaq, the S&P 500, a clean break of 4,300. As you were, the outperformance on the Nasdaq returns on the S&P 500, clean break of 4,300 on the S&P, the highest since April 21, 2022, a new high for 2023. That's the price action. Here's the trading diary. UBS could complete its Credit Suisse takeover as early as Monday. US CPI Tuesday, PPI Wednesday, the Fed Chair Jay Powell holding a news conference after the Fed decision on Wednesday. Then on Thursday, an ECB rate decision. On Friday, it's the BOJ's turn, followed by UMich consumer sentiment to round out the week. That rounds out a week for me. Enjoy the weekend. This is Bloomberg.